Hi, my name is Laylan, and I'm the owner of Top Financial Agency. And in this video, I want to talk to you about tax diversification, which I think is probably a super important topic when it comes to our finances, but it's something that I don't hear a lot of people talk about. I hear people talking about diversifying as far as the aggression level versus conservative, as far as how much risk, mitigating that risk. So people might say, well, I don't put a lot of my money in crypto because I think that it's super volatile compared to just opening up, like a Vanguard account and just putting some money there. So people are familiar with that, and that's something that they take into consideration. Now, when it comes to diversification and taxes, I sometimes hear people talking about the difference between a Roth IRA and a traditional IRA. So the Roth IRA is tax exempt and the traditional IRA isn't, but it doesn't just stop there. There are more options, and I think a better option that you could use to not pay taxes when it comes to your retirement. Now, I'm going to talk to you about the Index Universal Life, which is cash value life insurance policy, okay? So, a cash value life insurance policy is a life insurance. It's a permanent life insurance product, and I want you to picture it like this. There's two buckets of money. And this bucket of money is your death benefit. Let's say you have $500,000 of life insurance. If you pass away, that goes to your family. Now, and depending on the product that you have on the carrier, if you have a chronic, critical, or terminal illness like cancer, heart attack, or stroke, you could use that money while you're alive. Now, in this other bucket is money that's growing. It's called cash value. And this money is growing that you can loan from. And of course, since you don't pay taxes on loans, then it's income tax free. Then you can use that money. Now you can invest that money in as a down payment for a house, or you can put that money in another type of investment, put it back into your policy, then maybe take out some money later, or you want a kitchen remodel. I mean, this is money that you can use and you can loan against your own policies. So you're sort of becoming your own bank instead of having to get, personal loans somewhere else. But then the cons that people bring up about the life insurance policy is that the gains are not that high. Well, no, the gains are not going to be as high as crypto. I mean, if you get a good little coin at the right time and you buy it, I mean, you can bank, right? You can make a whole bunch of money on that. You can put it directly in the stock market. And if you really watch the stocks and you know what stocks to buy, then you can make a huge amount of money in the stock market. Then you can also, mitigate some of that risk and put it into sort of long-term investments when it comes to the stock market. So the life insurance policy, the cash value IUL, is going to be, first of all, it's going to give you a guarantee. So you're not going to lose any money. The principal or the gains are not going to lose. It's mirroring the index. So you're going to get some of the gains with zero of the losses. But are you going to get as high of a gain as if you put your money in crypto, as you put it directly in the stock market? No. Is it going to be the lowest bottom of the barrel like a savings account? No. It's probably going to be like 5%, 6%. If you look at a 5-year average, 6-year, 8-year, or 10-year average, I like to tell people 5 or 6% average. All the numbers are there. If you look at an illustration of an IUL, it tells you the historical data. So it's going to not give you super high gains. It's not going to give you the lowest gains. It's somewhere right there in the middle, but then you've got a guarantee. And when you use that money, you don't pay taxes on it. So it's almost like, okay, so you can make a whole bunch of money in this other product, but who knows what taxes are going to be down the road when you're ready to use that money? What if taxes are a lot higher than they are now, which potentially could happen? If you look at where we are, the national debt is super high, student loans, you've got Medicare, Social Security might be depleted by 2041. So if you look at our economics as a whole, the government is probably going to need more money from us, and they usually get more money from us in the form of taxes. So you could be making all of these gains in your retirement, and then fast forward, all of a sudden you have to pay a lot of that in taxes. So maybe it balanced out, maybe it didn't. Again, it just depends where the taxes are. But if you diversify, so you've got the tax now, tax later, and tax never, and if you put some more of those funds in the tax exempt category, then I think that's wise to do, right? That's your tax diversification. So these are the places where your money is, where it's taxed now. You've got savings account, checking, money market, mutual funds, stocks, bonds, EFT, crypto. All of that is taxed now. Tax later is your 401k, 403b, 457, CalPERS, CalSTRS, TSA, IRA, SEP IRAs, an IRA in the form of an annuity as well. Then you have the tax exempt, which is a Roth IRA, municipal bonds, the cash value life insurance. So these are all products that are tax exempt. Now, the challenge with the Roth IRA is that there's contribution limitations. With the cash value life insurance, the limitation as far as how much you can contribute to it depends on the size of your death benefit. So the bigger the death benefit, the more amount of money that you can put into it, but then you're also going to be committing to having to put a little bit more money into it, because the cash value life insurance policy has a range. So you've got the minimum amount that you can put into it to keep the policy alive, and then you've got the maximum amount of money that you can put into it before it becomes a taxable product. And as long as you stay within that range, it's good. And you can also design it to where you make the death benefit really small so that you can add more money into it to grow that cash value larger. I want you to think of it as sort of like a lever, right? So you want more cash value, you want to shrink the death benefit, you want more death benefit, then the cash value can shrink a little bit, or you find sort of a middle ground where you're trying to get a balance of both. But not only does it provide tax free money, which I hope I already made a strong case for why you want some of that money that you have in the future not to pay taxes on, not even in the future, just throughout your life. Like I mentioned, a kitchen remodel, I mentioned a vacation. Like, isn't it cool to be able to just grab some money that you don't have to pay taxes on and you can go and enjoy your things? Or if you have a kid that's going into college, you can take some of that money, help, your kid to go into college. Okay. But then the policy also has living benefits. That means in case of chronic, critical, or terminal illness, and again, this depends on which policy you get, you can use that death benefit while you're alive. So, like heart attack, cancer, stroke, things like that, you could use that policy while you're alive. Now, to show you this case study, this is a woman who's 37 years old, non smoker, contributing $500 a month, and she has $350,000 worth of coverage. In 10 years, she'll have about $61,000 in cash value. That's income that is potentially tax free. In 20 years, she'll have $188,000 of tax free income. And in 42 years, she'll have $1 million of tax free income. Now, if you're a parent, you might want to consider opening up a policy like this for your children. I opened up for each of my daughters. I have twins. When they were 4 months old, they each have $1 million in IUL in this product. When they are 65 or maybe a couple years before, they're going to have $1 million of tax-free income. Now, do they have to wait until they're 65 to use it? No, but I mean, that's pretty cool that there's $1 million that they don't have to pay taxes on when they're 65, but that's not the only money that they have. They also have annuities that they're going to be pretty set. And that doesn't consider the money that comes from my death benefit once I pass away. That's going to be more tax-free money for them. So life insurance, do I believe in life insurance? Yes, I do believe in life insurance. So you can just get yourself some life insurance, and you don't have to create it for retirement so that it's growing all this cash value. You just need life insurance in general, because if you get a heart attack, cancer, stroke, something like that happens, you need those living benefits. But then there's also this added benefit of having the tax-free money that you could use. Now, I did another video where I was talking about using leverage in this financial strategy that's called Kaizen. Basically, you open up an IUL, cash value life insurance policy, and a lender will contribute to it increasing your cash value, and then your death benefit is going to be a little bit larger. Then they get their money back from the cash value and you keep the rest of the cash value and the death benefit. I think it's a really cool financial strategy to help you catch up to retirement and grow more money. So I'm going to link that video over here. Now, if you want me to run some numbers specifically for you to give you an idea of what this will look like if you open up a policy, go to topfinancialagency.com, click on services, and then you can see there's tax-free retirement there for you. There's life insurance. There's just retirement, estate planning we do as well. And there's information that you can find on all of those. So I hope I provided you some value. Visit me, topfinancialagency.com. Thank you so much. Have a good day.